Is it too late for you to buy gold? Hi, my name is Cameron Osborne at the Daily Edge Trading Group, and in this video, I'm going to demonstrate that it is not too late to get into the gold mining sector, whether that's gold, silver, or gold miners, or any other precious metal, and why the fundamentals and the history of where we have been in the precious metal sector and commodities in general, and where we are today, and where I think it's actually going. So where I want to start is back in 1913. This is when the money changers won and the Federal Reserve was created. And the new fiat money system came into being. 1933, Great Depression. FDR goes off the gold standard and makes it impossible for normal citizens to own gold. Not for other governments, just U.S. citizens. They could no longer redeem their cash in exchange for gold. And then 1944, Bretton Woods, world's reserve currency for United States dollar, which is the only reason why the United States dollar hasn't collapsed completely, by the way, is because it's still the world's reserve currency. World banks around the globe hold United States dollars in reserve. 1971, Nixon closes the gold window now for other governments around the world. They can no longer redeem their cash for gold. So that officially took us or decoupled us from gold completely, and it's been a wild ride ever since. Since the 1800s, gold and the Dow Gold ratio is just what this is. It's the price of the Dow Jones relative to the price of gold. And for, over 100 years, this has been going steadily up. The Dow has been gaining on gold steadily with a best fit line that has a nice smooth path. Then step in the Federal Reserve in 1913. And all hell breaks loose. This caused the Dow to have extreme speculation, and the price went to crazy extremes, even worse than today, by the way, than 2020 or the tech bubble highs. And the Dow Gold ratio exploded into complete overbought speculation, and then a crash, and then the Dow Jones lost 90% of its value from the peak in 1929 down to the bottom somewhere in 1932, I think, 1931, 32, somewhere around there. So this wild volatility of the Dow Gold ratio has never stopped, but we have been in a predictable cycle pattern that kind of is in this expanding triangle, but the distance between peaks is somewhat regular. This is another way of looking at this, but using the commodity price index from, I think that this is a merge from Thomson Reuters and some other stuff, but it is showing that we could be embarking on a major super cycle in commodities that lasts at least 10 years, that all commodities around the world have bottomed, and we are about to embark on a crazy new rally. If we just decrease maybe a little bit more, is what this little blue line is actually projecting, and then rise up for years. This is another way of looking at that same chart. The commodity index relative to the S&P 500, but the distance between the troughs is kind of the same. And I've got this person who created this is a great chart, but the major events of the time for the peaks and troughs of this ratio are highlighted here. Oil crisis back in the 70s, and the 70s also gave birth to the 1979 inflation-adjusted high that we still haven't passed, by the way, depending on what CPI value you're actually using. I prefer the shadow stats for the CPI value that shows that gold was way above 2,000 back in the late 70s when 10-year interest rate was up near 15% and interest rates skyrocketed and inflation skyrocketed. That was right after this particular event for the 1973-74 oil crisis back then. Then the Gulf War. This is Desert Storm. Tech bubble. First tech bubble with the internet. This is in 2000, and stocks were at an extreme relative to commodities. So this is the inverse of that. This is commodities relative to the S&P 500. So low means that that the commodities are very undervalued. High means that commodities are greatly overvalued. And this in the great financial crisis that happened in 2008, gold and silver from 2000. A lot of people may not know this because they haven't looked at the charts, but gold hit like a low of $400 or something like that back in 1999, and it never stopped going up even through the financial crisis in 2008. Yes, there was a big reset with Lehman Brothers, but it didn't suffer. I mean, it suffered pretty bad, but it ended up getting right back to the bull market for gold and silver and the rest of commodities up until 2011 with Operation Twist that kicked off the big sell-off that lasted for 9 years until gold made a new high just recently. This is another way of looking at the commodity index, and we are at historical lows here. And this little bounce right here that happens at this big support level that goes back to the late 90s is a classic Wyckoff spring or down thrust or whatever the terminology you actually want to use. Big movement down, big doji candle at the bottom, which is an indecision candle, and then rocket right back up, which is probably going to make a very large V bottom in this area right here. That's kind of what I'm looking at. This is an interesting chart that actually kicked off the major breakout in 2018 for gold. And what this is showing is this is the Barclays total aggregate negative yield bonds. Long name, but that's what it's called. And in blue is the total negative yielding debt around the world. And this chart is a little bit old. I think it's from June or July, but it still paints an interesting picture. In 2018, in August, this started rising rapidly in blue. And gold spot in white in the background started rising with it. And I like using this because it shows that this is just another correlation with gold. The total amount of negative yielding debt around the world is very correlated with gold. And the more countries that advocate the usage of negative yielding debt, and back in October, or I think in 2019, I can't remember if it was 2019 or 2018, Germany's last bund, the 30-year bund, actually went negative, and their entire yield curve became negative. So this is bad news for anybody that's a saver, but it's great news for gold. 10-year real yield. There's a guy named George Gammon that has some great video on this that talks about real yield versus the actual treasury yield. And that's just the inflation, current inflation or projected inflation, plus the actual yield, plus the nominal yield that banks charge or whatever, the fees that they charge. And the real yield can actually get inverted. So the 10-year bond is the inverted 10-year bond, or just the inverted yield, is very correlated to gold over time, as you can clearly see from this chart here. So we do need 10-year bonds to continue to increase in value, and that means yields continue to decrease for gold to have a lasting bull market. So far, this correlation has been very accurate. I expect it to remain accurate in the future. The number of treasury purchases by the Federal Reserve are skyrocketing, and at a rate that is equal to QE 1, 2, and 3 from the 2010 years combined. We've already surpassed that, over $3 trillion printed in only a matter of a couple of months. So I expect that, and this isn't slowing down, by the way, and I'll get into a couple more slides that actually show that this is still increasing, and therefore the entire stock market is going to continue to increase, and gold will continue to increase. Basically everything. The Fed's buying it all. And this surge compared to 2008 in this same picture is just astronomical. The amount that they've actually the amount of treasuries that they're purchasing, and mortgage-backed securities also. Another way of looking at this is the amount of debt that the U.S. government is accumulating, and this is just another way of showing that it's just absolutely massive. And in 2008, in this chart, you can actually see where QE1, 2, and 3 start, and then they kind of peak in 2015. That's when QE3 ended, and then start to rise again in late 2019, actually, with Fed repo, and then skyrocketed when Treasury purchases joined mortgage-backed security purchases, and in a complete effort to save the entire U.S. economy. Not just banks this time, everything. Buying junk bonds in funds like HYG or LQD that are supposedly anonymous for the bonds that they're buying that are junk bonds, but who knows. So this is something that I wanted to show about, something that I saw earlier on Sentiment Trader, that we've got a reading on the sentiment for the dollar, and saying that it could increase back up in the opposite direction, United States dollar, at any time, but I don't think so, and I'm going to get into why I don't think so. G4 central bank balance sheet versus the world index. World index like world S&P 500 or something like that. I guess you can think of it that way. But the initial surge in 2008 is very interesting, that we had this big balance sheet surge that kicked off a gold rally for a couple of years, and we're having a similar surge again that's likely going to kick off a gold rally for the next couple of years. So this is just another reason, just another chart, just to show that we're repeating the past, basically. And as long as this correlation actually holds, then I'm going to have to believe it. And the central banks around the world have done their best to prevent a big crash in all of their local economies and their local indexes or indices, even to the point of buying their own stocks. So when everybody is printing money, all of the currencies around the world are getting devalued against gold. Gold is not just accelerating against the dollar, it's actually accelerating the slowest against the dollar. Something like XAU AUD or XAU NZD against the Australian dollar or New Zealand dollar, I think one of those is up at like 3,000 right now. So gold is accelerating versus all currencies because all central banks around the world are doing this activity. The United States, with respect to the United States Fed, with respect to the EU ECB, has printed upward of 350% the rate of the ECB, which is why we saw after the buyback of the dollar, when cash was king for just a little while, towards the bottom, cash was king. Everybody dumped everything that they had, including gold, including bonds, including commodities, including just everything, to get into cash because nothing was safe. That's the same thing that happened in Lehman Brothers October 2008, and I'm going to get into those charts a little bit later. But this is why the dollar is decreasing so rapidly against the euro, is because they are printing at a rate that far exceeds the rate of any other government or any of the other G7 governments around the world, or G4. This is just another chart or another graphic showing the same kind of idea. The rate of Fed central bank treasury purchases is just far exceeding any other bank out there. Of the top 5 banks, it's no contest. This is something I mentioned before called shadowstats.com, and this deals with the 2 different calculations of the CPI index, the consumer price index, that measures consumer inflation. And back in 1980, they stopped using cost of living as the direct measure of the index and started using certain purchasable goods, and those purchasable goods change all the time to dictate the CPI index. And according to the CPI index since 1980, in red at the bottom chart, it really hasn't done much except float somewhere in 2%, and recently being stubbornly low down at maybe 0%. For years and years and years, it's been floating around the average of 2 to 2.5%. However, using the alternate original CPI calculation, it has been floating above 5% for some time, and getting all the way up to 12-13% in 2009. And this is taking into account that a lot of the inflation is hidden in stocks and other assets like real estate. And real estate is skyrocketing. Lumber futures are at all-time highs because people are fleeing big cities to buy second homes or first homes in remote areas. I'm currently in Montana, and they are doing it here. They're doing it all throughout the Northwest because they want to escape the cities. And that is one of the reasons why lumber futures are accelerating so high, to the point that home builders and contractors are actually hoarding lumber in the form of, already carved up into pieces. They're just hoarding it, or just raw logs and hoarding it because they don't know when they're going to be able to get any more. And they need a surplus of raw materials so that they can keep up with the demand of houses being built. So the home builders index is doing extremely well, and it probably will keep doing that at least until October, when maybe some of these delinquent mortgages start to hit the market, and it starts being apparent on the balance sheets of the banks, because the rate of MBS purchases of the Fed cannot counteract the toxic debt that they're actually holding. This is a chart that I look at sometime on my own when I'm actually looking at it on TradingView. This is important because I like to look at the QE 1, 2, and 3 cycles with respect to treasuries being bought and mortgage-backed securities being bought by the Fed. And what this is showing is that the stock market, ever since 2009, was completely dependent on federal open market activity, on putting assets on their balance sheet, mostly in the form of MBS and treasuries, from the short end to the long end of the curve. And I don't have things like swaps on here because it doesn't mean as much. Each little top here in the markets from QE1, 2, and 3 all had to do with one of these two programs ending, or at least tapering. QE1 ended with MBS purchases stopping, and treasuries had already stopped in advance, but MBS was the one that really, had a little, and that was when you had that 2010 flash crash. And then QE2 ended, and that was if you can barely see it on there, but there's a little miniature head and shoulders on the price chart for the price candles that you can see there. And right when QE2 started to be tapered and ended is right when the market anticipated it and dropped 20%. QE3 was a little bit more tricky. You can see from the start of QE3 for both treasuries and MBS that they increased with a nice constant slope, and the stock market increased with a nice constant slope. And as soon as that died off for both programs, the market had a little bit more time to digest that because the program lasted longer. And eventually it did lead to a correction in 2015 that was around 20% again. And then that kicked off a major commodity bottom in early 2016, where it was great to be in metals, oil, everything. Fast forward to October, September 2019, repos started. That was the shot across the bow that something was very wrong with the markets. And then you had the crash for the coronavirus that was completely orchestrated, and it was the perfect pinprick to pop the market. And despite what anybody says, the coronavirus never had to be as bad as it was for the markets, but the the media and the dark pools and all of the big players made it true by doing their silent sells, and the silent hand actually moved over the market in a huge way that I talked about in a couple of different videos before this actually happened. And the writing was on the wall that something big was going to happen in January before any of the coronavirus news actually hit the tape, by the way. And I've got all the tweets and all the videos and stuff backing this up, that into as early as November I was saying something big is brewing. I don't know what it is, but something big is going to happen, and there could be a massive correction. I did not think it could be as big as it was. Dow Jones went all the way back to the 2016 election. Open is as far as back as it went, and that was pretty crazy. But this just goes to show that, the market is addicted to Fed bond buying. Commercial banks are tightening loan standards because they are writing what I talked about before, a huge amount of toxic debt, because consumers are delinquent on loans. They have commercial space that is running delinquent on loans. They refuse to pay the banks on their loans that they already have, and they're making new investments with Fed money. So it's a mad world right now, and banks, realizing the event that they're in, and it could be something very similar to 2008, are tightening up their lending standards, and loans that were offered only 8 months ago are now off the table. Even to people that have above 800 credit, they might not get the same loan that they had the chance to get before. And this could actually get worse into October once delinquencies start to become a reality, and they turn into not forbearance but actual defaults. This is just another chart showing global exports and just the similarities between now and 2009 and the recovery. And I expect stocks to recover and all commodities to recover with it. This is an idea that I posted right when we had a big break of this huge cup and handle of a retest of the 50-week moving average, which is also where the 200-day moving average was at the same location, and a big break of this on gold futures. The measured move that you can go on like Bolkowski.com and look at the pattern charts shows how to calculate the measured move for a cup and handle target, and it turned out to be about 2100. I just rounded to a nice round number, and that's what I found it to be. And I have been long gold ever since. I actually got in a little bit before this and started adding in the 1700 area, and I've been long ever since. And gold topped out somewhere around 2090 or so. So it has been a great year for gold, and I had never expected it to go up as fast as it did. Fast forward to today, the same chart, when you fast forward, it did almost get to that top target at 2100. Very, very shy of that target, maybe 2090 or so. And looks like the sellers came in and front ran it. And it is possible that we're doing some kind of a triangle here to go higher. I do not think that this is over. This is a breakout that is 9 years in the making to break the high that was in 2011 near the 2000 target. Something like 1994. The value was 1994 in 2011 or something. $1,994 in gold. And I do not expect this is over anytime soon. The euro is actually breaking out here on a trend line. And this trend line is many years in the making, all the way back to 2008. And we are above a key level, this November 2005 close, and we are above the 100-month EMA. This is a monthly chart of the euro, and this is at a key location here for a breakout that could last many years into the future. One thing that I wanted to note here is that for the month of March was one of the largest doji candles for the EU, Euro, USD that I have ever seen. The volume associated with that monthly candle was absolutely huge. And the fact that the first point that we broke on that doji was the high means that that's the true direction for that indecision candle for the entire month. And that would have the room for a much greater expansion over time. I have no doubt about it. That same trend line, the white trend line that I was just looking at here, this is the same white trend line in this picture. That same November 2005 close, and after this picture was taken, we've actually risen above it. I expect this trade to continue to build into long momentum all the way up to maybe 1.25 sometime next year is the kind of target that I have. But I'm showing this consolidation on the white trend line just above it, and I expect this to eventually break free and hit the 1.2 level and continue higher. This is a chart that I've been showing multiple times that has to deal with the dollar, how it was in 2008. And the key things that I have highlighted here are a reset moment where everything was sold, everything went down, and even the dollar went down. But the dollar got bid back up into the double bottom of March. And that buying up is this reset moment of all asset classes where they got sold off, and then the movement back in the other direction with the dollar, which is some kind of a zigzag move here, with the QE starting in early 2009, and then some last opportunity to short in June of that same year. And this is where we kind of realigned with the dollar starting in 2020. It's an accelerated version of this chart, but it looks like June is where we started, quote, realigning with the dollar in 2020. Very similar structure happened in 2020. A reset moment. This is the bottom in March, the dollar buyback, and then the dollar reality with the new QE that started at the end of March 23rd to be exact. After that QE started, the dollar started dropping rapidly with another kind of zigzag little correction, last opportunity to short somewhere in mid-June, and then a gradual precipitous sell-off. It breaks the old low that was back here. That same old low that was over here, we broke the same type of movement, and that's exactly what happened. And we have been kind of going sideways. This is a mirror image, just inverted, of the euro chart that I showed before of the dollar, because remember that the dollar represents 50% of the euro about, or it had 50% of its weight as the euro. So I predict that we travel in this channel, or maybe a flattened version of a channel, all the way until December. And gold actually keeps increasing all the way to December, which it actually did start to have another major breakout at the beginning of September in 2009, and it lasted all the way until December. This is a really interesting chart that shows that we could possibly be on some kind of a super cycle for the dollar. So the dollar likes to operate in these are the election cycles, and the 100 period month moving average, which is the reason why I showed it in the previous euro chart, that we are currently above and just passing and consolidating just above it. So the dollar is actually just passing the 100-month EMA to the downside and is consolidating right below it. And right here at this position, we are looking at a possible new dollar breakdown that would last for several years, just like in the last couple of instances. This is an interesting what-if scenario that I have, no idea if this could actually play out. I just thought it was interesting. I like to, do, postulations like this and see if it actually plays out. But what I was looking at was back in 1999 again. Remember, that's a key year. There was a huge initial surge on this weekly chart. Big surge right here in gold. This is a gold chart, weekly gold chart. Big surge, big retest, and the entire movement was a huge cup-like structure. Same thing starting in 2011. in the middle of the cup. Big surge starting at that 2016 commodity bottom. Retest, but not as bad. Not as bad. But it did not go below the lows, and then a gradual kind of sideways movement, and then the cup breakout. We're doing a very similar thing here. And back at this first point where it broke the recent high, there was about a 10% correction after it broke above the high. That's exactly what we got here. Gold did about a 10.3% correction from the high to the low so far. And then it made new highs. After that, it made another new high and then actually made a 13% correction before finally going higher. So we could see something like that happen again. Another new correction. We are extended from the 200-week moving average, which is what this yellow moving average is right here. We're pretty extended away from it. So we might need to go up and then correct again and then finally have the long run similar to this rally. But what I did project on here was that from bottom to top in about 11 years, gold made a 660% gain about. And if we were to do a similar gain, that would bring gold all the way up to about almost 8,000 is where gold would actually be. I don't know if this could happen. I just find it very interesting that these two big cup structures lasted about 8 to 9 years in both instances. And then at both instances, as soon as the cup was actually broken, it triggered a 10% sell-off. Even up here in 2011, the first high that was actually committed there, back in August, I think, August 2011, it immediately had a 10% correction, made a new high, then finally made an even deeper 30% correction. But it seems that 10% for a correction in gold is a key correction from recent highs that actually triggers a retest of those highs at the very least. Miners since September 2019 have been increasing faster than the NASDAQ, faster than, it's the performance is doing much better than silver, gold, which is exactly what you want to see. You want to see the miners outperforming when you bring it back to the beginning of repo, was at the beginning of this this chart here. And this is great news for people that are getting long into the mining stocks. This is something that I commented on McClellan earlier last week, and what the goal here was that I wanted to show that commercials, which is the smart money, actually got long dollar index futures somewhere around June of this year. They got long, and usually they're right. They're right eventually, but it may take a while, and you can see that the price has actually decreased a good amount since the dollar has actually decreased this entire time, despite them getting more and more long as it keeps decreasing. And if we go back to 2009, we had a similar outcome here. You can barely see it, but in May 2009, the commercials actually got long the dollar back in May, so off by a month this year. Remember, I said that 2009 and 2020 have a lot of correlations in the currency markets. They got long the dollar, stayed long, and then had a capitulation, meaning that somewhere in November, they capitulated finally probably on this big candle right here, and actually started getting short. So they looked at any opportunity of the dollar actually rising to totally get out of those longs. They realized it was a bad position and started shorting. And then they were forced to hold a short through all of this. So they got it right eventually, but it doesn't mean that they weren't wrong for many months before that. So if this is true, just like I showed in the previous pictures of relating the dollar in 2009 and relating it in 2020, we could have a very similar outcome where the ultimate dollar bottom is not until December or November of this year, just like it was in 2009. It's always important to look at who is buying gold and in what quantities, and the total number of registered and eligible ounces of gold that have been dumped on COMEX since March is just unprecedented. And eligible ounces are the ones that they are just storing on COMEX. They want to store it there. That's fine. They can store it in a pool, and they can they can hold on to it. They still own it. So if gold keeps increasing, their assets keep increasing, and their holdings will increase. The registered ones are the registered ounces that are available for people that are buying futures contracts for GC to take delivery. And the demand is super high to take delivery. Something that's we just have never seen this before. And who knows what this is going to mean in the future, but the demand is just skyrocketing to own gold. This is showing something very similar. This is the number of deliveries for gold. This is actually people that are accepting gold from warehouses, registered warehouses from the exchange, and they are actually receiving gold and holding on to it. This is the banks, this is private people, and for the first time, actually, a lot of private buyers are actually buying gold. This is showing a similar chart. Back after the 2000 bottom, after the tech crisis, there was a split in the eligible and registered. Before that, what it just was total stocks. Total stocks is registered and eligible. If you put it on COMEX, it was eligible to, or it was registered to basically be received for delivery for anybody that had an outstanding long futures contract at the end. And they would take your gold off your hands because you already gave it to the warehouse for safekeeping. But now they have separated it, and it is just showing that we have had exponential skyrocketing demand for gold. And you can see what happened after 2000. Remember, 1999 started a big gold run from $400 or so for gold that lasted all the way to 2011. So you could just imagine with this amount of movement, what is gold going to do if gold went from $400 to $1,900 in 10 years with this kind of slope of gold demand? What's it going to do with this kind of slope? It just makes you wonder. So I always like to look at some live charts of what we're talking about, and let's go and look at some metals charts to see what the current price action is actually doing and where I think the projection is actually going. So I've got gold spot up here in the center, and on the right I've got Telegram that has Daily Edge Live to show me on-demand block reports, because I'm going to pull up some interesting information for gold and silver that we've had some blocks come in over the last 2 days, Monday and Tuesday this week. In the last video that I talked about gold, I mentioned that with this big fall that happened because 10-year bonds and 30-year bonds also had a decent dropout. If I overlay 30-year bonds here, 30-year bonds futures, what we can actually see if I put this on a different scale, you can see that 30-year bonds actually exhibited a similar decline, a very rapid decline at the same time that gold decided to have its sell-off. And because gold was so overextended, any amount of weakness in gold was going to send it to at least a 5% sell-off. So bonds have recovered somewhat. We could be experiencing some kind of a double bottom here, and recently yesterday also. That could be a double bottom. We'll have to see. But that was just something to really look at, was that bonds are extremely correlated to gold still, despite stocks going up, despite the dollar just kind of hovering around. When bonds have a major sell-off, you're going to have a problem. So I like to use the 21-day highest close and 21-day lowest close. They behave very similar to shape as the 20-day Bollinger Bands, and this is a 4-hour chart, so I've got some multiple time frame stuff going on here. In my recent video, I notified people that this 21-day lowest close, if it got a strike finally after this channel went up to meet the price, and the 20-day Bollinger Bands also came up to meet the price after a huge expansion previously that it was probably going to generate a very large bounce. And one of the other reasons that I had was this monthly Camarilla S3 and monthly pivot was another huge support here that we actually kind of hit previously. There's another hidden support that I'm not showing, and this 200 SMA on the 4-hour chart has definitely shown that it is significant support. And in addition, there is also this weekly Camarilla S3 that I have circled here. So you have multiple time frames of pivots that were all acting at the same place in this congested area. Month pivot in cyan, month Camarilla S3, week Camarilla S3, 21-day lowest close, 200 SMA on 4-hour, and the previous 2011 high. So we're still above that 2011 high that we busted out of back here in late July. So that's a good sign. It looks like we're having some overnight retracement after hitting the weekly pivot here, which is this guy in cyan right here. But that's okay. We're going to have to see if we can really hold this and continue higher into tomorrow. And the goal would be to get some kind of a structure that's either a temporary topping structure or a continuation structure that looks like this. Something that looks like that. And this would be very similar to 2011 in August and a brand new high, and then maybe we do what we talked about in the video that I mentioned where in 2004, when we first broke out that cup, we had a 10% correction, then a retest of the high, then a 13% correction. That could be very well what happens after something like this with a new high being met. Another correction down this way that comes all the way down to maybe the 1800 area. That is something that's very possible. But right now we need to hold this area that we bounced off this morning. Silver, on the other hand, is in some kind of a triangle structure here, and I have highlighted above the 2011 high area and the 2011 low area, or January 2011 high, January 2011 low. It was a huge range that month, and these are important levels. And the reason why I highlighted it is because I thought that it would be significant support walking forward in the future, and it definitely is. And we're in some kind of a triangle pattern here, almost broke out above it, but hit this weekly R3 Camarilla R3 pivot at the same time we hit this triangle, and it didn't work out. We might have to get a retest again to make that happen. Let me take some of this stuff off here. And let me put these here so we can actually look at what I'm talking about when I'm mentioning these particular levels. So this is the level that I'm looking at on a weekly chart. I widened the rectangular supports and resistances to reach other significant lows just in the vicinity that would make this so that we could actually see the general support and resistance going back in time. So this particular area in between here, if we can stay inside of here, I suspect that we're going to have a similar resulting breakout once we break this high from January up at about the 31 to 3150 level. Once we can get past that, it means that we're off to the races probably again to do a similar path as what silver did back in 2011. If I head over to my Twitter page really quick, I can actually show you this. Here we go. So this guy right here is inflation adjusted gold, and this entire cup from 1979 all the way to 2011, and here's the handle. but here's that same cup and handle structure that I showed earlier in the video. So it's now we have a double cup and handle, and this is the same one. This cup and handle that I mentioned earlier in the video. If we look back at the block summary of metals over the last 2 days, and I changed it to CFDs so that I can get XAU and XAG, we're above a decent amount of blocks that we've had for GDX, silver, and gold. So dark pool and live blocks that we've had during the day for the last 2 days, and we're above them all. They were accumulating silver all in this area right here in the last 2 days. And when we actually punched up above them after hitting support, this is when I started adding to my silver position that I got down in here long down in this area, and I started adding to that position here. So I'm looking for higher highs, and the next target for silver would be this January 11 high up here near $31. All right, thanks for sticking with me on this video. Thank you for your time. Come join us at the Daily Edge Trading Group. We trade around the clock. We've got members from 8 different countries. We're trading stocks, options, equities, Forex, futures. We're doing it all. And we have the right skills, the right mentality, and the right collaboration to make these daily trades and have a daily edge in the markets where we can be consistently profitable together.